Welcome, everyone, to the Planet MicroCap Showcase Virtual. I'm your host, Robert Kraft. Now presenting here at our event is Charlie Bacon, President and CEO of Limbach Holdings. It's a publicly traded company. The symbol is LMB on NASDAQ. Charlie, take it away.
Thank you, Robert. Greatly appreciate this opportunity to present at your conference. We're very proud of our company, and you'll see that through my comments here about our business and where we're going. Limbach is a mechanical, electrical, plumbing, and building automation contractor, one of the largest in the United States, pretty much focused east of the Mississippi. And there's three words that I'd like you to think about as you start relating to Limbach and the business. The three words starting with essential. Humans need what we do: water, power, heat, air conditioning. That's what we provide. And when you think about the institutions and corporations that we provide our services to, we are integral, mission critical to their operations of their business. The second word is diverse. So we're in interesting times here economically, and our company isn't set on one market sector. We have many market sectors that we focus in on. We don't have a concentration of any one customer. In fact, we have over 1,200 customers. And finally, geography. We have 16 operations east of the Mississippi, servicing over 30 cities. And that's really important because as the economy fluctuates in different market sectors, geography, or customers, we shift our human capital resources to where the money's being spent or the needs are. Finally, evolving. The company's been around since 1901, and the business has constantly evolved. And currently, we're going through a big transformation that we launched in 2019, and we're shifting our business mix, which I'll get into, but it clearly is proving out from our financial returns we're delivering over the past number of quarters. Now, of course, we have our forward-looking statement here. I'm not going to read this to you, but this is our disclaimer. Now, I just touched on Limbach, who we are, and when you look at kind of really driving into what we do, we provide mechanical, electrical, plumbing, building automation, design, engineering, installation, maintenance, and energy management services that protect our customers' investments in commercial, institutional, and industrial facility assets. And how we're different is we have a dedicated in-house engineering group, which is phenomenal. Very few of our competitors have anything like it. And we're really focused on improving a building owner's ROI off that physical asset. Second point is we have an industry-leading platform that leads to diverse, value-added, technically complex engineering, design, enhanced services, meaning we really get into the systems and help owners understand how to be more efficient, whether it be energy or cost of construction or cost of remodeling. Finally, we provide a full life cycle service offering from the commencement of an idea all the way through the maintenance of the facility. On the right is our key data points. I just want to point out the share price. When this deck was originally constructed, following the release of Q3's results, we were trading at $7.57. Midday today, November 22nd, we were trading over $10 a share. So the market is responding to our continued, improved, and good, solid, consistent performance. Now, in terms of the services we offer, in the very center there, or maybe a little bit off to the right, you see MEP construction, mechanical, electrical, plumbing construction. Now, there are many firms out there that do that in the United States, but what separates us is what's on the left and to the right. So on the left, you see value creation. That's through the engineering group, energy modeling, building automation, and even down to facility analytics. We really help our customers understand how to optimize their buildings, be it new construction or retrofits or an energy retrofit type program. On the right-hand side, the real beauty of our business model is we create annuity income stream through the operations and maintenance of the facilities we either build new or renovate or retrofit. And we provide 24-hour emergency response type services. So the value creation, the recurring revenue, that's the beauty of our business model, and it really separates us. Now, we have two distinct customer segments. The first one is general contractors, and we refer to that as GCR. And the second segment is owner director, ODR. Now, this is really important for you to understand. We are going through a major transformation. Back in 2019, we decided to shift our focus away from the general contractor segment and over to the owner direct segment. It's pretty simple. We just make a lot more money working for owners than we do with general contractors. General contractors, we go and sell a building project at a 12 to 13% gross margin. And it's a kind of one and done type arrangement where we'll build the building, we'll retrofit the building, and we're done, and we have to sell another project. With the owners, we provide value solutions, and we become a partner with them in kind of a mission critical customer service provider arrangement. They need us to operate their businesses. They really like the relationships we establish, and we're very, very customer centric. Our goal in 2020 that we announced was to be a 50-50 revenue split by 2025. And here on the slide, you can see where the split is as of Q3. Today, we expect we'll be at the 50-50 mix 2 years earlier than originally projected. And actually, we don't expect to slow down in terms of the ODR growth, where you might start seeing a 40-60% or even 30-70% in the midterm as we continue to execute our strategy. Now, in terms of just investment highlights, we have strong tailwinds. The whole issue of onshoring, what's going on in China right now is causing manufacturers to think about coming back to the United States. Clearly, we already see a lot of opportunity with EV, solar, and battery type projects, but building owners are really, really focused on return on invested capital and the safety of the United States. So we're excited about kind of what's happening with manufacturing. The diversity I've already talked about between our geography and our market sectors, and of course the customers. The essential provider bit, that's where we're absolutely mission critical to that business. We have many, many customers that depend upon us to keep their business up and running, which is great. It's a very sticky relationship. They need us. The recurring revenues and margins on the rise, because we're shifting to ODR, we're seeing a great improvement on our gross profit margin, and that's obviously impacting our bottom line results in a positive way. The other part is the recurring revenue growth is phenomenal. The ODR side of our equation grew 40.2% in the past 12 months, and we still think there's a lot more growth to be had. We have a very strong balance sheet, net debt, $5.5 million. We're very, very healthy from a balance sheet perspective. And in recessionary times that we may be facing, obviously that's a position of strength. Finally, the company has a very attractive valuation versus peers. Recently, an investor asked me, when I think about my competitors, what is it that they have that you don't have? And I turned around and I said, they're multiple. So we're trading at a very low multiple. We have continued to deliver on our results and expectations on an annualized basis, and we expect to continue to do that. That's happened over the past several years. So I think we're going to earn that multiple over time, but right now, I believe the stock and our price, what we're trading at, it's a bargain. So wanted just to share an example of a customer relationship. Hospital Corporation of America is one of our major customers. We build, renovate, and maintain hospitals for them, mainly right now in the greater Florida region, a little bit in Texas. So they contacted us before Hurricane Ian struck Southwest Florida. And they asked us to be ready to help them get their buildings back up and running. They had obviously no idea what was going to happen. And in fact, a number of their hospitals went down. We were brought in the very next day, if not hours after the hurricane blew through the area. And we went to work helping them restore those facilities to get them back up and running. One of those facilities was actually written up in the Wall Street Journal. About lost its roof. The ER was flooded. Anyway, we were assisting HCA to get those buildings back up and running. That's the way our customers think about us. And that's where we're going as a company, to keep focusing in on customers like HCA. And we have over 1,200 of them to help us be sticky, help them wherever they need help, to make sure they get the greatest results they can out of their facilities. Now, in terms of diversity, which I mentioned earlier, you can see the slide really summarizes all of it. Our geographic footprint, which is pretty much east of the Mississippi plus Texas, and those blue shaded states are states that we're targeting acquisitions in. To the right of that, our services that we provide, I've already covered that in my earlier comments. In the lower left-hand side, you see some notable customers there that we have. We have over 1,200 owner direct relationships. And I'm going to get to that in a moment about where we're going with those relationships. And finally, we're not set in any one sector. You don't see any residential there, by the way. And if you think about home builders right now, they're in trouble because of the pullback in housing. Limbach has been built to deal with any sort of change in a particular market sector environment, and will shift the human capital to where the spend or opportunities are. And we're very good at that. Now, in terms of evolving, I mentioned how the company's been in existence for over 120 years. And we right now are looking to optimize our revenue mix so that 50-50 mix going to 60-40, 70-30, really rapidly growing our owner direct business. That's how we're going to optimize our returns. The strategic goals, I already went over that with you. And finally, the targeted acquisition strategy is something that's very, very important to us as we go forward. And one of the core reasons why we took the company public. Now, I just want to reinforce to all of you the issue of the building owner, why it's so important. The opportunity to go ahead and work with a general contractor, it provides us a pipeline to get a new relationship going with an owner we do not know. So as we retrofit a building or build a new building with a general contractor, we're working on the establishment of a ODR relationship, which will create that annuity income stream into the future. The building owners are so valuable to us because we're going to be able to drive expansion of revenue streams, and we're targeting owners with multiple buildings that we can keep growing our relationship with those owners. And it's also at higher margins. And the thing that I really have to emphasize, it's reduced risk working for an owner versus a general contractor. Now, in terms of just where we're going with the growth strategy, I mentioned earlier about the 1,200 owner direct relationships. We are laser focused today on stronger account management. And we really hit this hard in 2022, working with our business units, providing training, education, and development of account managers on how to figure out how to mine more wallet share out of the owners, really figuring out where else their needs are and selling them additional services. And that's going extremely well where we've already embarked upon it. We've got a lot more work to do there, and that's a great opportunity for the company. The return on labor, especially on the craft levels, there's a finite group of people out there today that we can employ. So we're looking to leverage the returns off of them, and we're getting a much better return off the ODR segment versus the GCR segment. The organic geographic expansion, that's all around pushing hard with customers to travel with them to new geographies. And we've established a number of offices over the past number of years on the back of a customer relationship where they asked us to go to a new geography. And finally, the synergistic acquisitions. We're looking for culturally compatible companies that can really help us grow our business through geography, through service offerings, through new owner direct relationships. And we have a lot to offer them. And I should note that our goal is to acquire those companies between 4 and 5 times EBITDA. Now, in terms of how we're doing, on the optimization of the ODR growth, it's really accelerating. Year on year, over 40% growth. In terms of GCR, right, we got this other segment. While that's contracting slightly, what's interesting is, yes, revenue is coming down, but look at the gross profit margin. On a TTM basis, it's increased dramatically on less revenue, and our margins are improving. Why is this happening? Because we're becoming laser focused and cherry picking the right opportunities. Now, on the acquisitions, again, you see the blue colored states here. These are the geographies that we're hunting in. We do have a full-time team seeking out acquisitions. We're looking at many, many deals. Our goal is to get 1 to 3 acquisitions done a year, but we're only going to do an acquisition if it's an attractive opportunity. We see the growth potential, and it really reinforces the ODR play and strategy that we've embarked upon. In terms of bottom line growth, so this chart provides an opportunity for you to look at our peers. EME is EMCOR, Fixes Comfort Systems. IESC is a electrical contractor. Primoris is a big civil industrial focused contractor based out of Texas. You can see on the gross margin level, because of our ODR shift, we're starting to blow them away. As a matter of fact, in Q3, we had 20.4% gross margin. So we keep improving the execution of our gross margin. Now, the operating margin, EBITDA margin, and cash flow, not as strong as our competitors yet. Now, we did do some restructuring in 2022. That would add about a percentage point to each one of these. We will not have that restructuring charge going into next year. What we did was we just figured out where we were making money and where we weren't making money. We made some strategic decisions to shut those operations down, and we've been very successful at it. The multiple that you see down at the bottom, you can see where EMCOR and Comfort are trading versus us. To us, we see this as a great opportunity as we continue to grow the business, have consistent earnings, and execute our strategy. We're going to hit those multiples. So it's a great investment opportunity. So finally, the investment summary, you've got a brand here that's over 121 years old, and we keep evolving. The diversification, we're ready to weather any sort of recessionary impact. The profit expansion, I just shared those numbers with you. The growth outlook, we're diversified to allow us to keep growing where the money's being spent, and it will be continued to be spent in healthcare, data centers, research and development. We're in the right sectors. The balance sheet is extremely strong, and we have a very clear acquisition strategy we're executing, and we have a strong balance sheet to allow us to do that with cash and future debt. So some guidance just on numbers, the revenue guidance that we just tightened up a little bit, and we increased our adjusted EBITDA guidance at the third quarter call or during the third quarter call. Those are the numbers that we're looking to deliver this year. And then we also provide some additional modeling considerations so people can understand where the business is going. Just two highlight comments. GCR revenue, I expect that to continue to contract slightly. With ODR, we grew by 40.2% year on year. That's not a reasonable modeling figure I would use. I think the low teens is a very conservative approach. In any case, we're going to continue to grow our bottom line. So I just want to close and say that we did raise the guidance in Q3. Things continue to improve. Insiders here at the company and our board of directors continue to buy. We have a very, very, very smart transformational strategy we're executing. And I'd like to share with you, I think we're in our fourth inning of a 9-inning game. So there's a lot more opportunity here for growth and continued progress on this ODR strategy. And we're 2 years ahead of schedule. Last thing I want to share with you, I've been the CEO of this company since 2004, and I have built one heck of a management team below me, starting off with Michael McCann, our Chief Operating Officer. He's an amazing individual. Our Chief Financial Officer, Jamie Brooks, came on board several years ago. She's done an outstanding job, especially with investor relationships. And the rest of the team I could get into, but I can assure you, they're equally as strong, and I'm very excited about the management team, our strategy, and our results. I want to thank you very much for this opportunity to present to you, and clearly, anytime you have additional questions, please reach out to the Equity Group, our investor relations firm, and they will either facilitate a meeting with management or answer the questions you may have. Thank you.
All right, Charlie, thank you very much for your presentation here today. You know, my first question for you as we get started here in this Q&A session, you mentioned that one of the company's growth strategies is M&A. So I'd love to hear from some of the criteria that the company has when looking at potential strategic acquisitions.
Yeah, look, we've been hunting now for the past couple of years. We did our first acquisition last year of Jake Marshall. That closed in December. And the reason we acquired Jake Marshall, I think it's a good example of the strategy. First of all, it got us into a new geography, into Tennessee. And that was very important. That's a growing area of the country. Number two, they have a very smart manufacturing and industrial base. We had some of that up in Ohio, up in Michigan, but not to the degree they brought to the table. So now we have their resume to leverage throughout the entire organization. And a big piece of that resume is owner direct focused. So they work with a lot of industrials, plant change outs, all sorts of upgrades. So it was exciting to get them on board. So geography, market sector, and then finally, they actually brought something very special to us. They have a manufacturing fabrication campus, which we're going to leverage throughout our entire organization. So, meaning we'll fabricate down in Tennessee, which is a lot less expensive than manufacturing up in Boston, for example. We'll ship the product to Boston. So overall, it's geography, sector, owner direct, and are there any other value adds they bring to us so that 1 + 1 = 4, 5, or 6?
Absolutely. Another question on the ODR versus GCR is one of the reasons that you're focusing on the ODR is that you have in-house general contractors that you can deploy to execute.
Oh, great question. Yeah, no, we've actually presented to our owners that we can provide a service called MEP Prime. That means we're the general contractor without calling us a general contractor. But we're only looking to do projects where there's heavy mechanical, electrical, plumbing, or building automation components. And there might be some steel or concrete, drywall, painting, whatever. We can sub that out actually to a general contractor. But the heavy work and where it takes a lot of intellectual capital to understand how to design, manufacture, install, commission, and to maintain those MEP systems, that's where we bring tremendous value to the owner, and they're recognizing that. That's why we see this account management strategy, understanding their needs, their pain points, and offering services to expand the revenue, wallet share, as I call it, back to us. That's how we're going to keep growing the business through owners.
Absolutely. All right. So another question I have for you, and I'm asking this to everybody on who's presenting here today. We're managing through tough markets right now. So what measures is the company taking to manage macroeconomic pressures that is currently affecting most microcap companies across the board?
What's interesting, as I said earlier, the company's been built to deal with these tough economic times we may be facing in terms of its diversity. And I did that with my old company, which was actually a general contracting company. I've only had 2 careers. Limbach and another company, I won't mention their name right now, but I've worked with them for 21 years. I worked my way up from assistant superintendent to CEO, and then we sold it. But anyway, here at Limbach, we're essential. Humans need what we do. So yeah, we have all these market sectors, we have the footprint, we have all these customers, but we're essential. People need what we provide. Finally, an example of how management acts. And I told you, I think we have an excellent management team. The people right below me that report in are incredible talent, like super talent. The pandemic hits, March of 20. We're all wondering what it all means. In a matter of a month, we cut overheads by 19%. We shed 19% like that. We didn't know what it meant, and that obviously hurt. That was very painful and very disturbing to do that with all the people. We really care about our people, but we had to do it to get really strong to weather a storm that we really didn't understand what was going to happen. I don't think anybody really understood it, but we took action like that. So when it comes to dealing with today's economic cycle, I think we're well positioned as a company, but management is not afraid to make those difficult choices to stay out of the game.
Absolutely. So, looking ahead to 2023, from what you can tell us, what would you say are some of the company's primary value catalysts that you want folks to pay attention to? You outlined a little bit about some of the numbers that you're hoping to hit. It sounds like for 2023 and moving forward. So I'd love to hear some of those value catalysts that will recognize that growth that you're hoping to achieve.
So the ODR growth, we do expect to continue to rapidly grow. For modeling purposes, I suggested, mid to low teens. I think we're going to do better than that. We'll have to see. But I think for modeling, stay conservative. But clearly, we're growing way faster than we thought, which is fantastic. And the nice thing about it, it doesn't take a lot more human capital to execute that growth, because the ODR segment doesn't require as many people versus the GCR segment. So with talent kind of being in a shortage situation, I think we're well positioned on the ODR strategy to continue that nice growth. The bottom line is what is important, and investors want to see us get to our peers. So right now, management is projecting, in the, call it near to midterm, we're looking to get to a 7% adjusted EBITDA figure. We're not there today, but you can see if you go back in the earnings of the company, we keep moving it up. We do need to leverage our public company expenses. We're a smaller company, but as we grow this business, be it organic as well as through acquisition, we will leverage those overheads and see that EBITDA and cash generation improve dramatically.
Absolutely. All right. So my final question then for you here today, and you more or less alluded to this a little bit, but maybe we get the full picture. So again, from what you can tell us, what are the corporate actions and or strategies that are being put into place to hopefully accomplish the goals that the company is setting for itself in 2023?
Yeah. So one of the big things we did over the past year was 18 months ago. We hired a new human resource director, and we managed to pull someone over from GE Aviation. We were fortunate to pick her up. She was tired of letting people go because of the 737 debacle. Engines couldn't be sold. They were laying off people at GE Aviation. And all of a sudden, she realized she could come to work for a smaller company and have a huge impact on us. And she's done an amazing job. She's our Chief People and Culture Officer. I mentioned the talent I have. She is amazing. So our learning and engagement team that reports into her, we've expanded that to really develop career paths. The shift from GCR to ODR, it's a big task. Kind of a little bit like who moved my cheese. But we put in the training programs to allow our folks to shift over to a different service offering. I mentioned we're in the fourth inning. It's going extremely well. I mean, we're winning the game, and it's exciting. But we've done things like that underneath to support the infrastructure of the company to allow this rapid growth to happen. So I hope that answers the question, but that's front and center of my mind right now.
Very good. I think that's a great place to close it. Charlie, again, thank you very much for your presentation today. And everyone, thank you for tuning in.
Thank you, Robert.